next one. Hello and welcome to the analysis of the first Monetary Policy Committee minutes that will be upon us any minute now, perhaps in the next 3 minutes. Let us remember that this is the first monetary policy, as on October 4th, that was taken by an entire panel. That is the Monetary Policy Committee. There were 6 members in that committee, 3 members which were appointed as external members and 3 members from the Reserve Bank itself. Governor, the Deputy Governor in charge of monetary policy. At the moment, that position is held by Mr. Gandhi, and an Executive Director appointed for the purposes of monetary policy, Mr. Michael Patra. The 3 external members who were appointed just a couple of weeks before October 4th are the pictures come up for you. Chetan Ghate is a professor of statistics at ISI. Pami Dua, the head of Department of Economics at Delhi School of Economics, and Mr. R. Dhulakia, who is a professor of professor of economics at the IIM Ahmedabad. The important point, as we have written there, cut repo rate for all 3 of them. All 6 of them voted that the repo rate be cut by 25 basis points. So it was a unanimous 6-0 vote in favor of a cut, as you can see. That's what we have from the monetary policy announcement itself. We had some indications in terms of a guidance, which was a bit mixed. What we were told, something which leaned a little on dovishness, but I mean, there were some important hawkish elements as well. The committee expects strong improvement in sowing and supply side measurements, which will keep food inflation outlook down. It notes the sharp drop in inflation, which reflects a downward shift in the momentum of food inflation. The government has announced measures to cool food inflation pressures with respect to pulses. This should help in moderating the momentum of food inflation. It has also opened up space for policy action, as indicated by the monetary policy statement itself. The easy liquidity conditions engendered by RBI's operations should also enable smooth transmission of policy. The committee took note of potential cost push measures. Those were the negative elements or the hawkish elements. Took note of the potential cost push measures that may emerge, including from the 7th Pay Commission award on house rent allowances, increase in minimum wages, and possible spillovers through minimum support prices. The fuller play of these factors will need vigilance to prevent a generalized cost spiral from taking root. On balance, the committee envisages a trajectory taking headline inflation towards the central tendency of 5% by March 2017, with risks tilted to the upside, albeit lower than in the second and the third monetary policy statements. This was what we got by way of outlook from the committee. So now we have to await the minutes of the meeting itself to see whether we get more details about the leanings of the 6 members. Also important was that in the media conference we got, okay, I think we've got the monetary policy minutes. We should be able to give you some details in just a bit. The minutes of the Monetary Policy Committee are with us. Just updating on the Reserve Bank website. So give me some time to be able to read it. To be fair, they have kept time. Okay, I'll just start reading. I have with me Dr. Pranab Sen, the former Principal Advisor to the Planning Commission and, of course, Chief Statistician. Also with me, Shubhda Rao, Chief Economist at Yes Bank. But welcome, and here are the details. Meeting was attended by all these 6 members. Where do we come to? The resolution on the basis of the assessment of the current and evolving macroeconomic situation at its meeting today, the Monetary Policy Committee decided to reduce the repo rate by 25 basis from 6.5 to 6.25. Then comes the assessment. Global growth has been slowing more than anticipated through 2016 so far, with weak investment and trade damping aggregate demand. Meanwhile, risks in the form of Brexit, banking stress in Europe, rebalancing of debt-fueled growth in China, rising protectionism and diminishing confidence in monetary policy have slanted the outlook to the downside. World trade volume has also contracted sharper than expected in the first half of 2016, and the outlook has worsened with the recent falling off of imports by advanced economies. I'll just check. This was, of course, the global outlook. It's a fairly long report that goes on for about 6 pages. Let me just see if there's an outlook. Outlook, the committee expects the strong improvement in sowing. Okay, that's very similar to what we got in the monetary policy statement itself. Okay, statement by Chetan Ghati. Maybe that will be of interest to us. In view of the good monsoon, decline in food inflation, better food supply management by the government, there has been some abatement of cyclical and structural risks to the March 2017 CPI. With persistent slack in the economy evidenced by unutilized capacity over the past few years, corporate pricing power remains weak. Persistence of core inflation remains a concern. Okay, so core inflation is a concern according to Ghate. Other things are dovish. While I recognize the upside risks to meeting the objective of 5% by fourth quarter, given the current juncture, these are acceptable risks. Expectations of future inflation at the monetary policy horizon, as evidenced by the survey of professional forecasters, are closer to the target. On growth, there are signs of revival. Taking into consideration all these, I vote for 25 basis at today's meeting. Okay, I think most of the statements are dovish. Statement by Pami Dua, the modest softening of inflation and inflation expectations seen in some of the surveys conducted by RBI, along with lackluster private investment and unused capacity, provide a window for reduction in policy rate. While RBI's inflation expectation survey of households suggests elevated inflation expectation, the consumer confidence survey represents an encouraging outlook for the price situation, as well as future economic conditions. Further, while the RBI's industrial outlook suggests some increase in input price rise pressures in the manufacturing sector in the short run, this is not expected to transmit to higher selling prices. On the other hand, input costs expectations are muted in the infrastructure sector. Additionally, the survey of professional forecasters suggests anchoring of inflation expectations. In this backdrop, I feel it's a good time to support growth by reducing the policy rate. I vote for 25 basis rate cut. Nobody is giving us an outlook. They're all just justifying the rate cut. Dholakia, some upside risk to inflation discussed in the MPC meeting in October 3rd and 4th, particularly arising out of the award of the 7th Pay Commission, are largely statistical according to me. Very dovish statement. Looking forward, in my opinion, the probability of inflation turning up from current level is reasonably less. On the other hand, there are good chances of the consumer inflation to soften further, substantially benefiting from good monsoon, supply management measures and ongoing reforms in terms of reducing costs. As far as growth outlook is concerned, I hold the view that the potential growth path of the economy is gradually moving up, particularly in response to reform measures implemented by the government. Since there is substantial underutilization of capacity in the system, I do not see major risks to inflation if the output gap closes fast. Given the above assessment, it gives me the comfort to vote in favor of a rate cut. I think one important sentence is, I see the potential growth path of the Indian economy is gradually moving up, slightly at odds with what Michael Patra said, that the neutral real rate is actually falling to 125 basis points. If the potential growth is moving up, why would the neutral real rate move down? Okay, here comes Michael Patra's statement. I vote for reduction by 25 basis. Several parts of the economy are languishing. But as the statement points out, other parts, agricultural activities, steel production, public investment in roads, railways, inland waterways, are mending and coming together for a potential revival. The most important among these policies is the improvement in the inflation outlook, a framework in which inflation forecasts congeal all available information and serve as the intermediate target of monetary policy. Two aspects are noteworthy. One, the level of the inflation forecast for Q4 of 2016-17 is closer to the target than before. And two, it has been moving down in relation to the second and third bi-monthly projections. This is not to say that the beast has been beaten or its back is broken, but there is a turn in its momentum that is exploitable, especially by measures that hold down month-on-month changes in prices of essential food items. Moreover, the reduction in inflation in August is more real than statistical, a collapse in momentum, which allows the play of the base effects. In the beneficial effects of the satisfactory monsoon, keep momentum muted and take inflation below projection for Q3. The target for Q4 should be achievable. Therefore, while staying focused on the path of disinflation, as set out in previous monetary policy statements, it is my view that now is the time to reduce the policy rate by 25 basis and drive the actualization of the macroeconomic configuration that seems to be forming. Okay, so that's, it is, okay, there's a last sentence which is important. It is crucial, however, to step up the vigil around the upturn in inflation projected in the last quarter of 16-17 to guard against any risk to the target. Okay, then there is Mr. Gandhi's statement, and finally Urjit Patel. I don't see too many forward-looking statements. Mr. Gandhi's statement: agree with the assessment to risks to growth and inflation presented in the MPC resolution, vote in favour of lowering policy. While risks to India's growth from a still fragile global economy have increased, particularly through the trade channel, risks to inflation from global factors may be easing. From amongst the domestic sources of risks to inflation, I see maximum comfort coming from pulses. The first advanced estimates of Kharif point to pulses production rising by 57%. Despite 2 consecutive years of droughts, food inflation contained. With normal monsoon this year, I expect food inflation to stay even more firmly contained. Then on the growth front, while the pace is expected to gain momentum, private investment cycle remains depressed, yet to respond adequately to improving consumption demand. Recent data on production of capital goods, import of capital goods, etc. indicate weak state of investment demand. In this environment, a rate cut, according to me, will help. And finally, Urjit Patel's statement, I guess most important, indicators of economic activity point to a subdued outlook, though gradually improving. Further, continuing low capacity utilization industry and persistence of the output gap suggested that pricing power is likely to remain low. Importantly, high frequency data embedded in our forward-looking surveys, as well as daily movements in prices of fruits and vegetables, cereals, even pulses, gave us some confidence that inflation target of 5% for Q4 can be achieved. Therefore, while our model-based projections indicated upside risk to the target, a calibrated policy judgment was warranted, given that some space for policy action had opened up with the fall in the August reading. Nonetheless, inflation outcomes in Q4 will have to be carefully and continuously monitored as upside risks, albeit lower than before, persist.